We're talking about a billionaire who basically treats the market like an opponent in a boxing ring, a speculator who plays pure defense, and the man who saw the absolute greatest financial crash of the 20th century coming, when frankly almost nobody else did. Yep, we're talking about Paul Tudor Jones. Let's get right into it. To really wrap our heads around the sheer magnitude of this story, we have to start on Monday, October 19th, 1987. From the second the opening bell rang, the selling just never let up. By the time the market finally, mercifully closed, the Dow had collapsed by a staggering 22%. I mean, just put that into perspective. It was a steeper one-day fall than anything seen even during the Great Panic of 1929. The panic spread like wildfire, from New York, straight to London, all the way to Hong Kong. Traders across the globe were literally wiped out in a single afternoon. But here's where we get to the shocking contrast. During that exact same month, while the rest of the financial world was essentially burning to the ground, Paul Tudor Jones's fund returned an extreme 62%. His positions were multiplying in value so fast that he effectively tripled his money in a matter of hours. The figure was so wildly extreme, so completely out of the norm, that when it was first reported, a lot of people just assumed it was a misprint. Okay, let's dive into this, because this right here is the central mystery we are unpacking today. How exactly does a guy from Memphis, Tennessee, who literally started out his career trading cotton, manage to predict a cataclysmic event that totally blindsided the smartest minds in finance? You know, his massive victory wasn't magic, and it definitely wasn't luck. It was the product of a highly methodical, intensely data-driven investigation into market history. Section 1. The Ghost of 1929, Discovering the Patterns of Panic. Let's transition back to the mid-1980s for a second. The American market was absolutely on fire, and almost everyone on Wall Street was convinced that the boom would just run forever. But inside his firm, Jones and his young research director, Peter Borish, started noticing something highly eccentric and honestly pretty concerning about this booming market. They started studying a crash that had happened nearly 60 years earlier. Borish actually took the market chart of the 1980s and overlaid it directly on top of the chart from the 1920s, leading into the Great Crash. The way these two lines rise together is almost perfect. Jones called the resemblance absolutely spooky, and you can see why. He was looking at two runaway markets, separated by 6 decades, climbing the exact same curve toward the exact same cliff edge. But it wasn't just squiggly lines on a chart. Jones looked under the hood at the fundamentals and saw a massive storm brewing. Stock valuations were stretched completely beyond anything the underlying corporate earnings could actually justify. Really, on any historical metric, the market was wildly overvalued. Then you add in the fact that there were zero limits on financial futures at the time, plus a new strategy called portfolio insurance. This was basically an automated selling mechanism that gave everyone a really dangerous false sense of security. Looking at all of this, Jones was absolutely convinced this was an accident just waiting to happen. Section 2. Learning to Fear Markets. The Costly Cotton Lessons. Now, spotting a trap is one thing, right? But betting your entire livelihood on it when the rest of the world is popping champagne takes a very specific kind of psychology. And to understand that, we have to look back. Before he was an untouchable billionaire, Jones was this brash, overconfident young broker. Back in 1976, he apprenticed under Eli Tullis, who was one of the most feared and respected cotton traders in the world. But after a late night of drinking in New Orleans, Jones actually fell asleep at his desk, right in full view of the trading floor. Tullis fired him on the spot. Later on, when he was trading up in New York, he piled into this massive, oversized cotton position, got way too greedy to take his profits, and when the market violently turned against him, he lost an estimated 60 to 70% of his clients' money. He went down to practically zero. It nearly ended his entire career before it even truly began. He was so sickened by that massive loss that he seriously considered just walking away from the business forever. But actually, rather than breaking him, the disaster completely rebuilt his psychology from the ground up. It forged his ultimate philosophy: protect the capital first, worry about the profits second. It taught him the absolutely invaluable lesson of defensive survival over greedy forecasting. He realized, the hard way, that having an unshakable nerve and absolute risk management were worth far, far more than any crystal ball prediction. And to make sure he never, ever forgot that agonizing lesson, he relied on another short, super blunt phrase: losers average losers. He literally taped those exact words to the wall right above his desk. Every single morning, he'd read them. It served as this constant, kind of haunting reminder to always manage his risk, cut his losses quickly, and never blindly hold on to a sinking position, just hoping it'll magically turn around. Section 3. Loading the weapon. Executing the trade of a lifetime. Bringing it back to the eve of Black Monday, we can see exactly how this deeply ingrained fear of financial ruin completely dictated his approach against the ghost of 1929. He didn't just guess a date, roll the dice. No way. His meticulous execution happened in 4 distinct steps. Step 1 was identifying those wildly overvalued metrics we talked about. Step 2, buying downside protection. But step 3, now what's really interesting about this setup is how he sized his short positions incredibly carefully. Because he knew for a fact he couldn't predict the exact day the market would break, he made sure that being early might sting a bit, but it would never ever destroy his fund. He built the position slowly. Essentially, he loaded a weapon, stepped back, and waited for the market itself, step 4, to finally pull the trigger. And oh man, when the market finally did pull that trigger in October 1987, the financial results were just astronomical. Like we touched on earlier, he tripled his money in hours while everyone else was in full-blown panic mode. But look at the total tally here. Jones personally cleared an estimated $100 million from that setup alone, and his fund finished the year up nearly 126%. By winning on the exact day everyone else was destroyed, this unknown Memphis trader became a Wall Street legend overnight. Section 4, the enduring paradox, the curse of the ultimate prediction. Now, this is where the story takes a super fascinating twist. In the days right after the 1987 crash, Jones was completely convinced he was watching the opening act of a second Great Depression. He was fully braced for total economic collapse. But that collapse never came. The new Federal Reserve chairman at the time, Alan Greenspan, immediately flooded the banking system with cash, bridging the gap and steadying the markets. So, ironically, the crash was very real, but the depression he predicted was not. Jones actually later admitted it was one of his worst macro forecasts ever. His unique genius was really in his defensive setup and his ability to react to the prices moving right in front of him, even when his larger, grim macroeconomic prophecy was completely dead wrong. For a long time after that, the wins just kept coming. I mean, he beautifully timed the 1990 Japanese Nikkei bubble collapse, making another absolute fortune on the way down. But massive success usually carries a hidden cost. His fund swelled way past $10 billion, and suddenly it was like he was trying to steer a heavy, anchored battleship through really narrow channels. The clean, powerful market trends he rode so perfectly in the 80s were competed away by armies of new, hungry rivals. Central banks pinned interest rates near zero, and those massive, volatile swings he thrived on, they just vanished. That dragged his once sky-high returns down into the single digits. So the crucial point we have to look at here is that his legendary gift for calling the exact top of the market seemed to kind of quietly desert him in his later years. Just look at the track record of his recent macro calls. He warned of a major recession in 2022. Wrong. He predicted a huge crash in 2023. Wrong. He called for fresh market lows in 2025, and then openly admitted he was wildly wrong about that too. The market just didn't behave the way his historical model suggested it should. But you know, despite these recent misfires, the billionaire boxer has never stopped swinging. He is in this endless hunt for the next massive macroeconomic shift, just constantly reinventing himself. In 2020, at age 65, this classic old-school chart trader absolutely shocked Wall Street by embracing Bitcoin as the ultimate inflation hedge. And more recently, he's been sounding a massive alarm on America's exploding national debt, placing really heavy bets against government bonds. The exact timing might elude him right now, but those defensive instincts, they are definitely still firing. Which brings us to our final, lingering thought for today. Paul Tudor Jones built his absolute empire by surviving the one day that destroyed practically everyone else. He was hyper-focused, he was structurally prepared, and he was deeply, deeply terrified of losing his capital. But as we reflect on this incredible, decades-long career, we really have to ask ourselves, does predicting the crash of a lifetime curse you to spend forever looking for the next one? It's a remarkably powerful psychological paradox and one that continues to drive one of Wall Street's most fascinating minds to this very day. Thanks so much for joining me on this explainer. Keep learning, keep questioning, and I'll catch you next time.